Thank you all for joining me here for the CLO Investor Roundtable. I'm WYNNE Comer. I'm COO of AGL Credit Management. I have a very distinguished panel of investors with us today to share their thoughts, and I'll let each of them introduce themselves, starting with Dan.
I'm Dan WOHLBERG. I'm a director at Eagle Point Credit Management, a specialist asset manager focused on CLO securities.
Good afternoon. Edwin Wilches from PGIM, focus on the firm's CLO tranche investments.
Matthew NATCHARIAN. I'm one of the founding partners of GREENSLEDGE Asset Management, a newly formed asset manager specializing in CLO tranches.
I'm Kevin CROFT, head of structured products at American Equity, an insurance company focused on mezz-type investing in CLO tranches.
CHANDRAJIT, CHAKRABORTY. We are a CLO investor focusing mainly on the equity and junior mezz tranches globally.
So thank you very much. So 2020 has been one of the busiest years on record in terms of volume of CLO business. But at the same time, we've seen less in terms of new issue deals. So year to date, we've only seen 22 managers issue CLOs versus 35 at this point last year. When I think about the CLO market, I'm going to start with Edwin, but I'd like everybody to talk about where in the CLO market you see the best value today.
Sure. I think, for us at least, it always depends on what your risk-reward sort of framework and approach is. For us, and for quite a long time, and candidly, I don't think it'll change, we still continue to think AAAs and at times AAs are the cheapest part of the structure on an absolute basis. I think a lot of it has to do with not just the amount of issuance and sort of complexity of the product. My underlying sort of generic belief is more, it's really just driven by bank funding, right? If investors could get repo through the bank market, which was obviously super prevalent pre-crisis when spreads were in the 20s, AAA spreads would compress. I think, until that changes, my guess is it just hangs out to be really cheap, and it's a great source of high-quality carry for a variety of different funds.
Dan, as a major equity investor, what are you thinking about the market today?
Well, I agree with Edwin that AAAs still seem to look cheap, and short AAs obviously look very nice today with a flat curve. As far as the equity market, I think secondary CLO equity has probably looked more interesting thus far this year, mostly just because of discount rates widening out and the idea that primary equity is somewhat range-bound. There have been opportunities in the secondary market to somewhat express views in equity and get more involved, more so at the beginning of this year than have been in the past. I also think new issue BBBs and BBs still continue to provide good relative risk-adjusted returns. Rates are still flat. Who knows what happens, but you still see good abilities to choose strong managers, strong portfolios, and strong structures. I think you need to be cautious these days to make sure you're aligning yourselves with the right managers and the right structures, but in general, there's still a lot of good relative value up and down the capital structure.
Chandrajit?
I think a lot depends on how you look at the tail risk in the portfolios. I think most of us here would agree there has been an incremental rise in the tail risk in most credit portfolios if you look at it. So that's, I think, one of the critical aspects. The other thing is when we look at debt versus equity, the option value that equity represents in general, a lot of it doesn't look to be in the money. So for example, if you look at the primary deals, obviously long reinvest creates option value, that's great. But if you look at most of the managers, how they have managed this portfolio through previous cycles, or rather mini cycles, not many of them have actually been able to capitalize on that option value and the long reinvest and so on. So that value in itself is quite questionable in my mind. So the most interesting trade is where secondary equity, definitely everybody agrees in this room, more than primary. But even within that, I would say the shorter deal, which is trading close around the NAV with high cash on cash. Because if you think about the high cash on cash, if you get a few of those, your PO essentially becomes almost free. And then if you have managed the tail risk well, you have some pretty decent upside from there.
Great. Matt or Kevin?
Sure, I think, relative to, the first half of last year, I think things have gotten healthier in terms of the dispersion we're seeing by managers, both at the AAA level and even at the BB level. And I think that's always very healthy. The more dispersion there is in how the market's valuing different managers and seasoned versus new deals means the market's more disciplined and doing a better job differentiating risk. When everybody's pricing at the same level or within 5 basis points of each other in new issue, it's not a sign of a healthy market. So I think this is a pretty good sign of a healthy market, and the fact that the spreads have been steepening. AAAs have tightened a bit, even though I agree they're still fundamentally very cheap, especially to similar asset classes, and BBs have widened out. That steepness is also very healthy. And at the same time, the tail risk that's in there has stabilized. It popped up last year, and it still moves around credit by credit, but the overall level of the tail risk has remained quite stable. And I think that's also a pretty constructive sign. So that, along with the better dispersion, means there's better opportunities to pick your spots.
And kind of going along with that, we think kind of that single A, triple B area is probably the most beneficial. So we're kind of seeing everything from equity all the way to AAA as being most beneficial across the panel. But also along those lines, when we look at new issue, we would prefer a new issue as opposed to a reset type transaction, and we prefer resets over refi transactions. So we like the ability to clean your portfolios with the new issue. At least the reset, you get a chance to really dig into the docs again. And the refi, we feel that those just have extension risk. And so that, while again, they're shorter non-calls and such, we don't want our portfolio churning over a ton. And so that's kind of how we think about where we place.
Piggybacking on that, most of the activity so far in 2020 has been in refis and resets. Chandra, how are you thinking about your portfolio of existing CLO equity, calling, refining, resetting?
The way I look at it, come back to the point that I made earlier, I don't see in the current market the option value that people talked about for a large part of 2018, for example, is in the money. I don't think it's in the money. So most of the resets, for example, if we look at in most situations, depending on how the portfolio NAV is, whether there has been a single B tranche, you are required to put in more equity and it costs a lot of money. The net summary of that is, for that to be paid back, you're looking at least 18, 24 months of reduced equity cash flows. Now, equity still is trading like a cash and cash product, and if you ascribe very little value, which it currently is, for the long-term optionality, I don't think resets make that much sense. But on the other hand, where the debt market has been, the tightening, as well as the most recent we've seen from beginning of this year, the steepening of the curve, where the shortening of the curve came in quite meaningfully, the refis make sense. And what it also does is allow you to, coming back to the point about the tail risk stabilizing, I see the market as kind of two folds. On one hand, you would see a bit of stabilization, I would see, around loan market technicals. But also on the other hand, you have seen higher level of prepayment, spread compression, which is obviously going to hit the CLOs pretty hard in terms of equity distribution. But on the other side of the spectrum, you would see an incrementally increased stress in selective credit, idiosyncratic risk, and the next earnings season, I'm sure we will see a bit more of that coming through these portfolios. So to answer the question, I think refis make sense to stay ahead of that curve, but I don't think resets in the current market makes too much sense.
Dan, how are you thinking about it?
Sure. I mean, not overly dissimilarly. I mean, the year started, I think, with the short end of the curve really moving first, and it opened up an opportunity for guys to start the market and do some refinancing trades. Obviously, a lot of managers have been faced with refinancing waves on the loan tranches, so the ability to be defensive and improve your liability cap stack while maybe improving some CQTs is helpful, especially when you have deals that may have a single B or maybe you're too early in their life cycle to consider a reset. That all being said, the good thing about refis is very often they beget resets, because when you start seeing the long paper pulled away for short buyers, very often that brings in the back end of the curve. And ultimately, I think it's very important to be considering buying reinvestment period as an equity buyer, especially when you have a large portfolio of opportunities and you're trying to think about it. So I do agree that whenever you're considering a reset, you have to think about how much equity I have to top up. Am I going to put in an X note instead, which might depress my payments and things of that nature? But the ability to buy reinvestment period, especially as AAA spreads continue to tighten, maybe at a flat mark or even at an accretive mark, I mean, that option in itself is very, very worthwhile for any equity portfolio that wants to be able to churn and trade in any less benign market, which I think, whether or not technicals are better and good, I think we all agree we certainly are in.
Thanks. We've seen finally for a long time, we've seen equity trading in the secondary market, not just minority, but also majority equity pieces. Why is that, and is it good value, and what are the most important metrics to measure when you're trading equity? We'll start with Matt.
Sure. I think, we have seen a bit of an increase, and I think, so much money had been raised for equity in various types of funds and other formats. I think you've seen people starting to look for a little liquidity. No specific trend there, but I just think, over time there is pressure for investors to cash out in some way, shape, or form, and I think that has contributed to some of it. And I think, the market historically has always looked at a lot of different metrics, whether it's NAV plus 1 year of payments, 2 years of payments, long-term IRR. It feels a little schizophrenic in terms of where things are trading and in which way people are looking at it. And I think, one of the most common things we're seeing is things just trading on cash yield for the next year. And, that makes me think it's mostly dominated by hedge funds that, are taking advantage of that and maybe taking the position on over a shorter term horizon. Our focus when we're looking at the secondary equities right now is really digging into that tail. So even if it's stabilized, you have to really have your own view on exactly what that tail's worth to have an accurate bid on the equity, and that's where you have to spend most of your time. But then also the spread compression that's going on. So we spend a lot of time looking at the trading, especially the most recent trading being done by the managers. Where are they actually getting money to work? And that's really got to drive the assumptions you're using. Because, we're investing for equity always as if we're going to keep it forever. Now, certainly we aren't always going to keep it forever, but, when you're setting your valuation, we think you do really need to look at that perspective as your most heavily weighted case, because you very well could be stuck with it.
That's great. Anybody else?
I think one point I was trying to make is we have kind of gone through quite a bit of that cycle of when we look at equity, do we look at as a short, medium-term trade, or we keep it forever? Now, keep it forever, which I think most people in this room will agree, our recent experience has been, by and large, a single-digit product. Now, 11, 12x levered portfolio of largely single B rated loan producing somewhere in the single digit. I'm not sure that's the right compensation for holding equity type risk. So I think the more relevant is from a trading point of view, where is the value? And that's where I think NAV comes again and again as a very important measure for two particular reasons. One is any which CLO equity you look at, ultimately, for a short-term trading point of view, NAV is the single most measure, NAV plus 1 year, 2 year, whatever coupon you look at. Obviously, cash on cash is important, but NAV forms the bedrock of it. The second thing, when we talk to managers, a lot of them will talk about the exceptionally low default experience, how well they have managed through the cycle, but what it doesn't capture their trading behavior. If they trade out of every loan as it falls 2 points, sure, your default experience would be 0, but you're losing NAV every time you're doing that. Similarly, triple Cs. Are those triple Cs trading at par or near par, or are they really beaten up, going below 90s or even in 80s? So all of that gets captured in NAV, and I do think that's a very important measure, not just today's NAV when you're looking at secondary. What's your view on that NAV for that equity position going forward?
I think that's a really good point, because NAV has been moving up and down pretty dramatically over the last year. Edwin, I know you have a view on if NAV is the right way to look at valuing credits as well?
Yeah, I think it's challenging. I think, there's, generically speaking, I think all these metrics are really important and, they're helpful, but they're really just a tool for you to kind of either compare deals across, the universe or sort of look for outliers or try to understand what's going on. But it's really just step one of multi steps. I mean, the reality is, when we look at portfolios in general, the NAVs are good, but at the same time, without a loan team or someone that's trading the underlying, it is challenging to know where things really are trading. There's a lot of loans, if they're haven't traded in a while, the marks are stale. We definitely see this in the U.S. You absolutely see it a lot in Europe. Sometimes we do manager meetings, we're talking about different credits, and they're like, I'd love to sell this thing at 70 if I could. It's like, oh, okay, interesting. Let's see, where's it marked? Like, whatever, 75. Like, where do you think the bid is? 50, 55, I don't know, it doesn't trade. Right, so it's kind of like, you look at these metrics, but then you gotta, as everyone else has been suggesting, go through this portfolio and say, all right, where does this thing ultimately shake out? What does it mean? How does it work? And, in CLO investing, I think the challenge is you have to understand the portfolio, so you have to know the loans. You have to know the structure. Obviously, when things get cut off, when you get paid, when you don't get paid, how the managers do the stuff, and then you have to understand what the manager may or may not do. So I think it's a multifaceted thing. Right? You see the metrics, and then you dig in, you go through the loans, you go talk to the manager, you got to understand the structure. We did a bunch of work during the crisis, like post-crisis, obviously, but we took one portfolio of a deal that we owned, and then we stuck the same exact portfolio in another structure, and the differences between equity distributions, pay downs on the senior debt, completely different, and it was the same exact portfolio, right? So the structural piece is huge. So it's multifaceted. It's not just that, but.
And also the manager, I would say, because you can do however much underwriting on that portfolio, but that portfolio will change. You can start with the 2% CCC. Down the year, you could have 10% CCC. So a lot of things can and will change. So you have to take a view on how that manager has managed and what the natural management style has been. Because we've seen portfolios where generally very conservative managers, conservative low VAS portfolios, if you push them higher, they'll eventually fall back to their natural level.
Yeah, and the challenge, I think, too, I mean, we've seen it definitely in the last year, but you'll see, and you'll talk to a lot of different folks, and it's like, you can overly think about the tail, but then there's also, like, you're almost like a first default, right? So it could be any of the 300 credits that are going to kill you. You just don't know. Most likely, probabilistically, it's this lower rated stuff, but you've seen, I mean, you could pull this out of Intex, like, people call the deal, and the tail that they thought they owned isn't that at all. It's like the loan that's at 95 that has no bid and they can't sell it. Now the equity is just long one name or two names because there's just no bids.
Right, right.
Right, so it's really interesting, like where you see things trade. Sometimes they'll even trade under NAV, and some of it is just, are the bids real? Can you actually sell it there? Can you get any liquidity on it? When does it settle? I mean, there's a lot of nuances to this market.
Kevin, you are focused mostly on the primary market, so I'm curious, when you think about NAV, is that a factor in your analysis, or are you just focused on the manager? How do you analyze your opportunities?
We would echo a lot of the things you both have said. Manager, structure, collateral are by far the three most relevant things that we look at. We look at the MVOC, and we really view it, similar to Edwin, that it's kind of a point-in-time metric. If we're going to purely trade and hold it for a very short period of time, which is not our style, then I think MVOC is a very good metric from which to choose. But when you start thinking about how's it going to perform through time, and the through time performance is going to be driven a lot by the collateral and the structure. And those are the two things that we spend a lot more energy on, modeling the structure, seeing where the stressors hit it, where it survives, and where it fails.
So we saw a few new innovative transactions done, CBOs, high CCC bucket CLOs. I'd like to open it up to the group. Kevin or anybody else, are you interested in these assets, and would you invest in them, and why?
Yeah, I can start off. We are not interested in kind of the alternative CLO type deals. We like the BSL CLO product. The alignment of the floating rate assets with the floating rate liabilities is really nice. CBO deals can introduce fixed versus floating type risk that we don't view as a nice ALM fit. Another benefit that we see of the BSL CLO is the better recovery of the first lien loans as compared to the generally lower recovery of senior unsecured high yield debt. And then for those buckets where some deals have those really high CCC baskets, we're a debt investor, and we look at a lot of that as being much more optionality for the equity investor. And so we're looking at deals that aren't as opportunistic for one set of the capital stack versus the other. We're looking ones that are more naturally downside protection, which aligns more with us as a debt investor.
Got it.
I would say we have looked at a few of those. Some of them, I think, do make sense in small proportion, definitely not for the entire portfolio, for the simple reason that in those kind of, call it the alternative structure, you can take a contrarian view. So for example, let's take the example of high CCC CLO portfolios. They're designed to absorb and take higher CCCs as rated accordingly, is tranched accordingly, and as debt investors, you get compensated for that. And I think if you look at the risk return profile for those, probably it's more favorable than the regular way BSL deals. But the beauty of that kind of a product is in the market when many other managers and CLOs are trying to reduce their CLO buckets and selling out of them, these kind of vehicles can be a natural buyer and can pick up some good value. There are CCCs that are really still fairly solid credit, good cash flows, and you can pick them up at good value in those kind of structures. So there are some pockets of good value to be had in those alternative structures.
And how are you thinking about the alternative assets?
Sure, yeah. I mean, the enhanced CCC deals, I think we've looked at pretty extensively, but haven't gotten involved yet. I think there's a couple of questions you have to think about when you're looking at them. I mean, first, you're basically entering into a trade that you're hoping at some point will have some sort of great rotation, right, where CCCs will take up a larger portion of the market, and then at that point, your manager is going to be able to pick the right ones from the wrong ones and outperform on that basis. And there's a lot in that statement, right? I mean, you have to really have conviction in your manager. We're talking about CCC rated credit. The sales have to actually materialize when the good CCCs are actually being punted by CLO managers, when we know that CLOs aren't for sellers. And it has to all happen within the set time you've put in for a reinvestment period, or else you're probably going to underperform. So before you even go into it, you have to have conversations with the manager as to how are you going to handle the time period before it occurs. And then when you see the opportunity set, how exactly you're going to take advantage of it. And then you have to have the structural understanding to really build those structures with the tools that actually work on those days. Because who knows if there's something in there that might trip you up one way or another that you're not really thinking about. So it's something that takes a lot of diligence and a lot of timing. I do think it's an interesting thing, but it's not something we've gotten involved in yet. CBOs, I think, obviously make sense. Obviously, collateralized bonds make a lot of sense. There's less managers that do them, and you need a certain amount of real expertise to do it. I think one interesting fact to overlay is, we've heard some changes to Volcker that are coming, which may open up bank participation in CBOs at least the AAA, AA level, which might be able to help the pricing on some of those. We'll see.
One thing just wanted to add to that is, in my limited experience in investing in CLOs over however many years, I've learned one thing, and one thing only probably, that things get worse. Things can and will get worse. So if I can have a structure that will pay me for that, I will take it any day.
And we've been pretty, I don't know if active is the right word, but we've participated in a bunch of these deals. I agree with Dan. I mean, they are structured very differently, so it's not necessarily the same way as a BSL deal. The way we generally approach it, I mentioned it earlier, right? It's we think about it as a cost of funding thing, and we're a leverage provider for this investor that wants to get access to this part of the market. It's hard or near impossible to get any type of term facility for that from a bank, or if you could, you can't do a lot of it. So we've found the handful of trades we've done to be pretty attractive. I mean, most of these spreads do come in pretty wide, sometimes wider than AA's. And in my mind, you know, a senior bond that's going to delever if things get really bad is still way better than a AA at wider spreads. But you know, it's all manager, collateral, all that stuff has to sort of line up. So they are very different trades, though.
Yeah, I would distinguish between the two groups even a little bit more strongly than some have already. I mean, the CBOs, having lived through, you know, being an investor in the late 90s when CBOs blew up spectacularly, I think you do have to watch out for that interest rate mismatch. You don't want deals that have interest rate hedging in them. And I think so far there's been very little, if any, of that. But that could sneak back into the market, and you have to be very wary of that because when there are defaults, the hedges don't shrink automatically. So there's no excess spread left. Now, those lessons are what gave birth to the CLO market as we know it now, and the new CBOs that have been created are very strong structurally. And that's very important. If you're lending to an equity investor who is saying, we want to take advantage of the market when it dislocates by buying high-yield bonds or buying lower-rated loans, whatever the exact strategy is, they should not be pushing for every little stip they can get to pass out par gains or, you know, otherwise make their arbitrage work, because it's not an arbitrage trade, it's an opportunistic trade. And if you like the manager and you like the structure and it has good structural features and you're getting paid for it, you should be absolutely willing to invest in that. But if you have managers that are pushing the envelope to get cash out of those deals, even though they're making, you know, they're asking you to make this investment that gives them leverage that they can use in tough times, and you're doing it at a rate now that's in a more, you know, absent today's sell-off, but you're in a more calm period of time, you really need to get paid for that, and it's really in the steps, and you shouldn't let managers get away with lots of different ways where they can pay out the par gains prematurely. And I think, you know, the CBOs have been much stronger in that, especially the earliest ones. And like any new product, you know, the first ones are often the best ones, and then, you know, it'll get a little bit weaker and a little bit weaker. So I think investors just have to be very careful about that.
Great. I'm going to turn a little bit to the collateral. Kevin, I'm going to start with you, but could you talk a little bit about how much you're seeing a rise in B3s or CCC names and how you're thinking about those in terms of your managers?
Sure. The increase in B3 and B- is by far the greatest concerns that we have. Number one, it does drive MVOC lower, as we were talking, but really the next step for a B3 or a B- loan could be CCC, and that's where it becomes concerning for us. We've seen some of the lowest tranches in deals with higher CCC exposure get downgraded. Where that comes into play as an insurance company, a regulated entity, we have to hold more capital if we see downgrades on our positions. And so we really like to see ratings be stable or upgraded as opposed to withstanding some downgrades. So we're very focused on where that CCC is. The good news is, across our portfolio, it's somewhere around 3.5% CCCs with buckets that are 7.5% wide. So while we're monitoring the B3 risk, we really haven't seen the CCC risk, and except for about 5 or 7 deals, really become a concern for us. Importantly, though, even if you breach your 7.5% CCC bucket, it doesn't mean the whole deal stops. It doesn't mean it's an event of default or anything of great risk. It just shows that the collateral has a higher MVOC volatility, and it might really lead to some deleveraging coming up as they go through some hard times.
Anybody else?
Luckily for us, we are not regulated as you guys are. And luckily for us, there's no capital requirement. So if it's a pure rating-driven situation where you're feeling uncomfortable looking to sell, hey, I have pockets where I can buy them. And that's what makes the market, right? So I see this as an opportunity where provided, and I will say this is an important issue, provided there is no fundamental deterioration in the portfolio. And that's where we try to kind of distinguish between fundamental quality of the pool. That was the idiosyncratic credit risk that I was talking about, the loan market being by far in two parts, as we see. One part is going to see more and more stress and fundamental credit concerns and idiosyncratic risk. The other part seeing prepayments and spread compression. So it's really down to those fundamental issues what the real value is. But if the opportunity arises just pure ratings downgrade, I'm all for it. I'm a buyer.
Yeah, I mean, I think we'll continue seeing it. You know, there's I think S&P LCD had the stat at, you know, a third of all loans have some sort of EBITDA add back. I think our back of the envelope numbers, you probably get another turn of leverage. To the extent that folks are missing earnings, whether it's because they were too aggressive in the synergies or simply because, you know, the businesses aren't working how they're supposed to, or some operational integration issue, you're going to continue to see downgrades. You know, we obviously look at it. We're on top of it. We're not, you know, we're mostly asset management, so it's not. We don't care about ratings as much aside from liquidity. But you know, for us, it's you know, I mean, B2s go just as quickly to triple Cs as a B3, so it's really kind of trying to underwrite these portfolios and see what's in there. You know, the market itself, right? It's not just loans. There's record triple Bs in IG. There's record single Bs in loans, and the only place that's actually gotten better is bonds because the loans took all the bad stuff. So I think, you know, we'll continue seeing it. You'll see this bifurcation. It's been tough, right? It's like the high quality stuff gets tighter, and the tail that hasn't moved enough. Maybe it's moved on paper, but I don't know how much it's actually moved. So it'll be interesting, but we continue to expect more downgrades and definitely much lower recoveries the next time around.
Got it. Dan, how are you thinking about your manager portfolio, and which manager style do you think is the best to invest in right now?
Oh, man, I have to pick one. I don't think you can really say what manager style, you know, is better than others. I think in general we look for managers that actively trade their portfolios, who are generally engaged on a day-to-day basis, and who use volatile markets as opportunities to create kind of par gain opportunities. There haven't been as many of those opportunities, and when they've come, they've been very quick. So it takes really agile, intelligent, and capable managers who understand the markets. You know, I joke all the time that there are kind of 4 C's I look for in a manager: credit, CQTs, cash, and connections. The idea is you have to understand the fundamentals of credit, you have to understand the fundamentals of the structure, and then you have to have the capital and the connections in the market to really execute on those days. You know, there are volatility creates a lot of opportunities. The structure provides you the ability to take advantage of those opportunities. You know, there are times where you can, you know, take swap opportunities and things like that can really be accretive long term to CLO portfolios. And when you look at the way that Cov Light has kind of changed our market and some other ways that our market has been changed, you know, discounted purchases very often are how managers are going to be able to build par back up at times when there have been par losses. So, you know, it's really going to be the guys who understand the structure and understand credit that are going to be able to do the best work.
Anybody
I
else?
mean, from what we've observed, at least, I think and I think everyone's been saying it in one way or another, I think that the biggest challenge is, I think in theory, all that stuff works, and in practice, very few people execute it. So if there's, you know, 140 managers, I'd bet you maybe 10 will do a good job. So it's really tough, right, to figure this out. Mm-hmm. I'm guessing you don't have 50 managers in your portfolio, right? You're picking the 10 best that you think are actually going to do that. And the reality is it's really hard to be super nimble. It's really hard to do all these trades on the manager side when you're staring at really big bid ask. And, you know, it takes a lot of, you know, conviction and courage and connections, as you said, to figure it all out. So I think we're generally, we get the you know, your long vol to some degree, but it's more technical vol, not fundamental issues. But the reality is most people don't capture it. People just get, you know, they get scared of everything or whatever. It just doesn't happen. But, you know, we've had 2 or 3 episodes where there was, you know, back end of 18 was a great opportunity to buy. You saw the retail funds selling all their double Bs because they had to raise liquidity. into year end, and most managers didn't do much. So it's just really interesting.
Yeah, I think that can be hard to judge over a short period of time, like what we saw in the fourth quarter last year. But I do think, there are managers that are specifically more aggressive and focused on finding trade opportunities. And I think this environment is certainly better for them. That doesn't mean they can go out and capitalize on it every single day. But, in terms of style, there are definitely more aggressive trading styles and less aggressive trading styles. And I think the environment today favors those that are more aggressive. That said, it also favors those that are more conservative on credit. And I think the group that it doesn't help right now are the group that tries to get out of a credit early before there are any problems. I think that's maybe that's not one distinctive style, but that's certainly a strategy that some both conservative and maybe more aggressive risk takers do advocate. And I think that style has suffered lately.
I think to Matt's point, I think the thing we look for is managers that are going to be right. And sometimes it's an aggressive style, sometimes it's a conservative style. And the hardest thing, as Edwin said, is knowing in advance which manager is going to be right. And so we know we don't know who's going to be right. So what do we do to kind of slant things in our favor? We tend to focus on those managers who have larger staffs, who have been together for a longer tenure, and then also have the breadth of assets or connections in the space so that they can move assets effectively. They've done it before, they've worked together. Those are the kinds of things that kind of like traits that we look for. They're not certainties, but they're certainly traits, and try to find those managers who have a good slant towards those.
Yeah, I was going to say similar things, right? Because when the market sells off, obviously the conservative manager will look great. When the market's rallying, the aggressive manager will clearly outperform most of the people. But it's really, the important thing is how are they managing the portfolio? As I was saying before, there are managers, so we have seen ample evidence of that. The CCC bucket is super low, default experience practically close to zero. Why? Because they sell every possible loan that shows the slightest sign of stress. Look at how their NAV is performing. Of course, every CLO equity you buy, new issue or with ample life left, that NAV will go down. That's fact. But how quickly it goes down and how is that value preserved? I'm not even talking of value creation. Of course, there are few that create value. That's great. That's kind of, I would say, like a 3 sigma event. I'm looking for value preserving or slowing down the rate of value destruction. Because frankly, from an equity point of view, the way I see it, if it's a regular way, 50 basis point, 10x levered, so 5 points out of my pocket day one, whether they perform or not perform. No other asset class I can think of where I'll get paid 5 points whether I perform or don't perform. So clearly, from a manager point of view, I'm looking somebody who can help me not even gain back all of it, but preserve as much of that capital back through the cycle. And that's critical.
That's great. I'm going to turn it to Matt, and actually, you have just started GREENSLEDGE, and I'd like to know how you are thinking about setting up the business today, given all your history in the market.
The single biggest difference is the technology. It's, when we were first started building a business in the late 90s, there was no technology out there specific to investing in these types of securities. Now it feels like you just, search for it on Amazon and you can find a CLO system. There's a lot of good information out there that you can subscribe to, whether it's credit-specific information or certainly the systems that are out there to analyze CLOs. And, we got to spend a couple months trying a whole bunch of them, and that was really fun because it was, we had our own system before, so we weren't going to go out and buy another one. So it was a lot of fun to spend time with these other systems that we had heard about over the years and try them all out and put them through their paces. And they all have their strengths and weaknesses, but it's amazing how much information you can put together about this industry, about this sector, about managers, and do it pretty efficiently. So that's been I wouldn't call it eye-opening because we had good systems in our past jobs, and But it's just been a lot of fun doing that, and it is, I think, for any new investors out there, there are a lot of tools available, and I think that really gives you an advantage over what people were doing in the past, going back 10 or 15 years as this industry got started. So I think that's really positive, and you can best use that information to hold managers' feet to the fire. That's something I've always advocated for. That's something where it won't be any different in the future as I invest in CLOs as I've done it in the past. Holding managers accountable for the credits they're selecting and the trades they're doing, and making sure they know you're paying attention, and things like these tools that are available, really, I think, make that easier. So I think, you can do this more efficiently than maybe you could in the past.
Yeah, I think that has been one of the big changes in the market, where the data was always available, but now we have the tools to be able to capture and analyze that in a meaningful way. I mean, if you think about roughly about 1,400, 1,500 CLOs outstanding, every CLO produces a 200-page trustee report every month. Think about the amount of data, 200 times 1,400 times every month. There was no possible way a human could have analyzed that. So that's where the tools and the technology to be able to really cut through that to see the real trends, managers, sectors, performance, credit, whatever we talked about, different structures, that has been really the big change in how you invest in CLOs and what is going to happen after that.
So I think that's a good entry to, 10 years on from the last downturn, the CLO market continues to attract new investors like Matt, although you're not really a new investor. How has the CLO buyer base changed over the past year, and how has the market adapted? This is jump ball for anybody.
I think the biggest change, if I may start, has been obviously the whole regulation that came about, risk retention, and even though in the US that went away for a large part of the market, the legacy of that, the captive or affiliate capital base. I think that changed a lot of the dynamic, supply demand, the return requirement, and how the CLO market operates. So that has been one of the big changes in terms of the buyer base. Of course, aside from that, the relative value argument, which people have made for a very long time, have really appealed, and it's a much wider participation that we see in the CLO space than we've ever seen before. But the single biggest factor that applies to the supply-demand dynamic, especially on the equity side of it, is really the captive capital.
Yeah, I would second that. I think it's really interesting. Coming out of the crisis, most of the equity deals, or at least the folks that we could observe, was mostly third-party equity, like hedge funds or some sort of credit fund doing it. I think over time, it was just, I think, the unintended consequence of regulation actually pushed the market to have an excuse to go pitch pension and sovereign wealth funds to do risk retention funds. And the thing, we've seen a lot more is, just pensions or sovereign wealth funds, instead of hiring someone to buy the 10 managers, they've seen the 10 managers, they'll just go buy their risk retention fund. We continue to see a lot of that, so call it formerly known risk retention funds, but, when we do manager meetings, I tell you that, so we've probably met with at least 70 managers in the last 4 months, and at least 2/3 have some sort of fund that's raised or been raised to get them through issuance for a long time, which I think is partly why it's hard to just look at the CLO arbitrage math, because a lot of people aren't looking at that. It's a different trade. It's shifted from pure arbitrage to some business building as well, which is fine, but we definitely have seen much more of that part of the market increase, which I think, and then the other probably bigger difference has been asset managers. I mean, even this year, you've seen a lot more asset managers coming in. Again, yield opportunities, what else are you buying, come back, across the capital structure.
Yeah, definitely agree that the dynamic shifted from the pure arbitrage math. Yeah. Otherwise, why would single-digit RR CLOs equity getting printed? Of course, because there's a captive audience, they will take that.
Yeah, I agree that over the last couple of years, I think the risk retention rules brought some of the big guys into the CLO equity market, and that helped grow our market a lot because, big names were out pitching captive equity funds. What we've seen is actually a little bit different than I think what Edwin's seen, which is we seem to be seeing a lot of struggles in those re-raises. I would estimate that captive equity from the first raise is down materially from where it was. I think that investors either didn't get exactly what they bargained for or now see that the regulatory purpose is gone and there's some more opportunity to diversify and do some different things. I don't think it's exiting our market, but I don't think it ever wasn't in our market. Obviously, before risk retention, there were always asset managers who liked to own their own equity. So from that perspective, it's certainly up. We do think the trend is a little bit down. What I do think is also interesting is the diversification and growth in the debt investor base, that we all wish there were more of them. I do think that one thing that's noteworthy was that we had a large slowdown in Japanese AAA buying last year, and AAA's tightened. So, I mean, that shows that there are more guys out there who are interested in the space, and somewhat of a net effect of that growth in a good way, in that there are more people out there up and down the capital structure who like to look at CLOs now.
But there's a big fundamental difference to that point. Previously, also, CLO managers did take some portion of their CLO equity. That was great. That was alignment of interest along with the third-party equity. But the captive funds we're talking of, there is zero alignment of interest. That is completely dedicated third-party capital that's buying into that equity. There is no alignment with the principles of the CLO manager on that. So that's a totally different thing in my mind.
Yeah, absolutely. I think that the investor base is somewhat more wise to that now than maybe they were. And I think when it was solving a regulatory problem, that made a lot more sense. I think when it's not solving a regulatory problem, that agency concern becomes a little bit greater.
Yeah, I was going to say it's a principal versus agent thing. And one, you're like almost pitched as being the GP of this business. So you're really thinking about the business, not necessarily the one QSIP or whatever.
Exactly.
Yeah, right. Which is fine.
Yeah.
Matt or Kevin?
I know when I think of changes through time, a few things come to my mind, and one certainly is the creativity that occurs from the group that attends an event like this, whether it be CRE CLOs, even though I don't like them, the CCC CLOs, the return of CBOs. The creativity just astounds me every year when we get a new turn of the page. The other thing from a buyer base, I think that's pretty rampant is an experience similar to what ours was. We first got involved in the CLO market after the crisis, so 2.0 investor, like 2011 kind of a vintage. We could get 400 spread on a single A CLO. We thought that was pretty good, and in hindsight, it was incredibly good. But when we think of it, what did we do from there? Well, we got to know the product, we got to know the managers, develop our set and kind of right level where we think things should be. And then what did we do? We expanded across the spectrum. And so we went from being a AA, single A investor to being a triple B and then ultimately a double B investor, and really identifying how we wanted to play, the flexibility of the structures, the opportunity sets that this, from a debt investor, that this kind of market presents. So I don't think our experience is unique. I think there's a lot of other investors who've done a similar kind of road.
That's great. All right, Matt, you got the last word.
And I can just add to that. I think there are some investors that look at that, they want to get involved and have been trying to get involved, but it does take, notwithstanding my comment about Amazon before, it does take some resources to set up the systems, and it takes some capital and some effort and some people. So I think there is increased interest in hiring that out and outsourcing it. And I think, that's part of what we're trying to take advantage of, is I think the buyer base is growing because of there's better awareness of the asset class, but also how to do it well. And so I think there are investors coming to the market looking for help. And also, people mentioned asset managers are getting involved. I think it's important to point out that if you drill into that, there's a lot of more traditional fixed income, core plus fixed income, and other, just high-grade strategies that if you went back 5 years, none of them had CLOs, and if you go forward now, sometimes CLOs might be one of the largest allocations they have in the portfolio. And that is a big mind change difference, and it's been helped by the fact that liquidity's been really good. I think our secondary market has been pretty disciplined. And although lots of people like to complain about the BWIC process and all that, it evolved out of the crisis, and it's served our market pretty well in terms of the functional liquidity you have at most of the debt classes in the CLO. And I think that's helped grow the buyer base.
Well, that's a perfect ending. So I'd like to thank our panelists. Thank you very much for your time, your insights, and thank you very much.